Hi, my name is Chance Eaton. I'm the Chief Learning Officer here at Big Skyway, and for today's little learning nugget, I want to share with you Chance's top 10 financial ratios. And so this is regardless of what industry you're in. These are the top 10 ratios I look at, and depending on your industry, we might dig into deeper ratios that are more meaningful for you, but these are just my top 10 generic ratios. Let's start off with number 1, liquidity. This is where we look at your current assets. They have life of less than a year, divided by your current liabilities. They're due within the next year. And so the dirty rule of thumb is 2 to 1, but it's telling us how much cushion do you have. You can have too much liquidity, you can have not enough liquidity, and your bank will help you out with what they're comfortable with. Ratio number 2, a solvency ratio, or sometimes called a leverage ratio. It's your debt to asset. How much of your assets are actually financed by debt? Talk to your bank about what they're comfortable with. You can have too much debt to asset, bank will get kind of nervous, but if you're really profitable, a lot of companies try to expand that debt because debt is cheaper than equity, so they get some leverage. Talk to your banker about what they're comfortable with. Ratio number 3, or metric number 3, I should say, top line revenue. Just what is that number? And metric number 4, what is that revenue growth, that top line growth? That's something I'm drawn to right away. Metric number 5, gross margin. So I take my revenues minus my direct costs, my cost of goods sold. Though that's going to give me my gross margin. I want to know what is that gross profit margin relative to my revenue, and there's my gross margin. And it depends what kind of industry you're in. I'm in the service industry. We'd expect a really high gross margin versus retail or maybe manufacturing. Metric number 6 I'm really interested in is called EBIDTA. So I've got my gross margin. I take away all my operating expenses. EBIDTA is earnings before interest, depreciation, taxes, and amortization. A nice apples to apples cash number. And that's something we'd use for valuation. And once I have EBIDTA, I can do something else the bank's going to be looking at. It's called the debt service coverage ratio. I can take my EBIDTA and I can divide it by those principal payments that are due in the next year and the interest payments that are due, all those debt payments. What is the EBIDTA, my cash, available to cover and service those debt payments? I can have too much cushion, but it's just showing me how much room I have and if I can make those, if I can expand, etc. So that's something else the bank's going to look at. And then, of course, we get down here to net income. I'm interested in that number, but more importantly, I'm interested in the net income, the profit margin, the net income relative to revenue. And that's going to be different from industry to industry. Now, for our last 2 metrics, we have return on asset and return on equity. And these are probably the first numbers I actually look at to round up my top 10. ROA is your net income divided by your assets. Some metrics will throw in interest, that's fine, but what is the total investment that I'm making in the company? How much profit am I making relative to all this investment in assets? My return on asset. Even more important, ROE is return on equity. How much money am I making? This is net income divided by my equity. That's my investment in the company. How much has that grown by? Okay. And a little dirty rule of thumb is when my ROE is bigger than my ROA, it means I'm making money on the bank's money. And I like making money on the bank's money. So there's Chance's top 10 ratios, regardless of industry. A lot of other ratios you can dig into, but I hope that helps give you a little more financial acumen as you look at your financial statements.